Hello and welcome to a new session. In this session, we're diving into IFRS 15, Revenue from Contracts with Customers. This standard is all about when and how companies recognize revenue. Think of it like a rulebook that ensures revenue is recorded consistently and correctly. To do this, IFRS 15 gives us a 5-step model, and we're going to break it down step by step. Let's get started. The 5-step model for revenue recognition. IFRS 15 follows 5 key steps when recognizing revenue. First, identify the contract with the customer. Second, identify the performance obligations in the contract. Third, determine the transaction price, how much the company will get paid. Fourth, allocate the transaction price across the different obligations. Fifth, recognize revenue when, or as, the obligations are met. We'll go through each step in detail. Step 1. Identifying the contract. A contract is just an agreement between two or more parties that creates rights and obligations. It can be written, verbal, or implied through business practices. For a contract to count under IFRS 15, it must be approved by both parties, clearly define the rights of each party, have payment terms in place, have commercial substance, it must be a real business transaction, have a probable expectation of payment. If multiple contracts are negotiated together or have linked performance obligations, they may need to be combined under IFRS 15. If there are any changes to the contract, we need to check whether they should be treated as a new contract or just an adjustment to the existing one. A performance obligation is basically a promise to transfer a distinct good or service to a customer. What is a distinct good or service? A product or service is distinct if the customer can use it by itself or with things they already own. It's clearly separate from the other items in the contract. Example: a software company sells a package that includes a software license, installation services, 1 year of technical support. Here, there are 3 separate performance obligations because each one provides a distinct benefit to the customer. If a good or service isn't distinct, it must be bundled together and treated as a single performance obligation. Step 3. Determining the transaction price. The transaction price is the total amount a company expects to receive in exchange for its goods or services. Some key factors to consider. Fixed versus variable consideration. A fixed price is set, while a variable price depends on bonuses, discounts, or penalties. Significant financing component. If payment is delayed or paid in advance, we adjust for the time value of money. Non-cash consideration. If payment is made with goods services instead of cash, we record the fair value. Consideration payable to a customer. If a company gives discounts or refunds later, the transaction price is reduced accordingly. Step 4. Allocating the transaction price. Once we know the total transaction price, we need to split it among the different performance obligations. This is done based on their standalone selling prices, that is, how much each item would sell for separately. If it is not readily available, estimate it by considering all information that is reasonably available, such as market conditions, specific factors, and class of customers. If there's a discount, it should be spread across all items unless one specific item gets the full discount. Example: a company sells a phone and a service plan together for $1,000. The phone normally sells for $900, and the service plan for $300. Since the total standalone price is $1,200, we allocate the price proportionally. Phone, $900, divided by $1,200, times 1,000 equals $750. Service plan, $300, divided by $1,200, times 1,000 equals $250. Step 5. Recognizing revenue. Revenue is recognized when, or as, the company satisfies a performance obligation. There are 2 ways to recognize revenue. At a point in time, when control is transferred immediately, for example, buying a laptop from a store. Over time, when the company delivers the service over a period, for example, a construction company building a bridge. Let's break down a simple example to understand the 5-step model of revenue recognition. Take 20 seconds to read through the question. Alright, let's walk through how we apply the 5-step model to this question step by step. Step 1. Identify the contract. Arun has a contract with a customer to sell a computer and provide 12 months of technical support for $399. Step 2. Identify the performance obligations. There are 2 distinct obligations in the contract. Delivering the computer. Providing 12 months of technical support. Step 3. Determine the transaction price. The total price agreed is $399. Step 4. Allocate the transaction price. Now, let's split this $399 between the computer and tech support based on their normal selling prices. Computer, $300. Technical support, $120. Total standalone price equals $420, that is, $300 plus $120. Now, we allocate the $399 proportionally. Computer, 300 divided by 420, times 399 equals $285. Technical support, 120 divided by 420, times 399 equals $114. Step 5. Recognize the revenue. For the computer, $285 is recognized immediately on March 1, 2024, when the computer is delivered. For the technical support, $114 is recognized over 12 months, meaning $9.50 per month. Let's also see the journal entries for this question. First, to record the sale on March 1st. Debit, cash, $399. Credit, revenue, computer, $285. Credit, deferred revenue, tech support, $114. Then, on March 31st, to recognize tech support revenue for March. Debit, deferred revenue $9.50. Credit, revenue, tech support, $9.50. So, total revenue recognized for March 2024 equals $294.50.